Hey there, everyone. I'm Janice Hernandez, Vice President of Communications and Marketing, in for Gilbert Gonzalez. Today, I'm talking with Michael Guertin, a certified public accountant and founder of Aperto, an accounting firm that is dedicated to helping small business owners achieve their long-term financial outcomes. He's here to talk with us about good habits that will help small business owners thrive. Welcome, Michael. We're so happy to have you on.
Thank you, Janice. Glad to be here.
So, before we start digging into some of the deeper things around taxes, tell me a little bit about what are some of the things that our realtors need to know about the current state of the IRS.
The IRS is not in a good condition right now. So historically, it's an organization that's been underfunded, with antiquated systems and understaffed. And so COVID-19 really pushed all those things over the edge. And the IRS was shut down for quite a bit longer than most of the rest of us, I think. And at the height of the pandemic, literally piles and piles of paper were being stacked up. You know, the USPS was just dumping tax returns, checks from people, everything into big rooms, and they weren't getting processed. And so the backlog continues. And as of the end of the year, there were approximately 6 million unprocessed returns from 2020, which is crazy. There were about 2.7 million unprocessed amendments. I mean, these are staggering numbers. And last year, the IRS was so overwhelmed by phone calls, and I'll talk a little bit more about some of the letters that are going out because, you know, every time the IRS sends an automated letter, then someone wants to call in and deal with that, right? They get upset, they get nervous. They got so many phone calls that they only were able to answer 11% of all their calls last year. It's just crazy numbers, and it's getting better, but it's still pretty bad. And so there's a huge backlog. There's a lot of collection notices going out to people. So what happens is, say we had the winter storms last year, and the extended our due date got extended, but it got extended past everybody else's into June. And so that messed up with extensions, right? So what started happening is people may have filed an extension, then filed their tax return, and those two things got processed out of order. That causes a notice to which the IRS says, hey, you filed your return late, it wasn't extended. You say, no, I try to call the IRS, they don't answer, and it's a big mess, right? And so the IRS is trying to address it by putting a bunch of extra staff on backlog. So they've assigned 1,200 people to try to process some of these returns. But that's kind of crazy, right? Because we're in tax season again. Officially kicked off about 4 weeks ago. And they've already told us it's going to be the worst one yet. So what I encourage realtors to do, and we're going to get into some of this in just a minute, is to try to make sure you stay on the straight and narrow path, right? Make sure you don't get into any deviations where when the process works like it's supposed to and your return goes electronically and they accept it electronically, people are getting their refunds in 4 or 5 days, that kind of stuff. It works the way it's supposed to. The second that it deviates because we don't do something right, it goes into this purgatory where they're completely behind. They can't answer the phone. So we want to try to avoid those things, and I'll kind of give a few tips on how we do that as we progress here.
Well, I mean, it sounds like it's already an overwhelming time. Not only if you're a new realtor in the business, if you're a veteran realtor, you continue to experience some of these overwhelming things when it comes to tax seasons. So can you tell us some of the basics that someone would need to know when they're looking at their small business tax documents?
Yeah, I think let's just start there, right? Let's start from the lens of I'm a new realtor. You are a business owner now. Whether I know you probably hear it, you might hear it in your realtor orientation, you might hear it from your broker. You're a business owner, so the newest thing for you is you got to file Schedule C. Right? You have a brand new schedule in your tax return you never had before. It's more complicated than you're used to, and it's got more responsibilities. Right? You're getting a 1099 from your broker. So that's a whole new thing where that 1099, the first thing you got to do is make sure it's correct. Mistakes happen. I've got seasoned realtors that have been doing this a long time, but their 1099s are messed up and they have to go back and work it out with the broker. And that's a process. It takes time. So that's the first thing you do is go match up your 1099 to your actual collections in the bank to see if it agrees, right? you now have to generate a profit and loss. Like what's a profit and loss? Like, well, you're responsible for knowing what your income was and what all your expenses were. And many of you may have been exposed to something that someone provided you, like a cheat sheet of how to collect your expenses, and some of you haven't. What we do is we call it a realtor expense worksheet, and over time we've crafted an expense worksheet for realtors that kind of works like how you work, right? So you have costs related to getting a deal done. You might have HOA transfer fees, listing costs, staging, photography. So we'll have that section. We'll have the things where you're caring for yourself, dues, subscriptions, CE, licensing, all that stuff, your dues, and then the things that you're doing to maintain a home office. So you got to capture all this, right? Because if you're going to a tax professional, or if you're going to TurboTax and filling this out, no one's going to do it for you. It's got to come from somewhere. So to file taxes, you need your 1099. You need a profit and loss that explains, how much you made and how much you spent in all these different categories, just so you can fill out Schedule C, right? And then there are some things you probably should be aware of that are new for this year. One is your meals are 100% deductible. So your meals with your clients, where you took them to lunch in between showings, the meals that you had to work on your business, your working meals, or maybe your strategy meals with a spouse or another realtor, those are 100% deductible this year for 2021 and for 2022. And that's something that was enacted a year ago to kind of spur the restaurant industry. So watch that just to make sure we're seeing some nuance in the tax software around you're having to be very intentional to code it as 100% write-off, because the old write-off is 50%. So that's important. Two other new things, and this is kind of trying to keep you in the straight and narrow with the IRS. Most of us got a third stimulus check last year in the beginning of the year, in the first quarter. And then some of us that have kids have been receiving since July these advanced child tax credits. And both of those programs are, one, contributing to the backlog and problems at the IRS, and two, being reported very messy from the IRS. So for either of those things, assuming you haven't moved and the IRS knows where you are, you should be getting letters. Okay, so rule number one is what we're asking our clients to do is, hey, we want to see the letter. You got a letter from the IRS, dig it up. If you tossed it or you didn't get it, then we ask our clients to log into the IRS website and find the information. And you need to, if you're married, you got to both do that, because they're splitting these amounts up. Like I've seen situations where the advanced child tax credit gets apportioned 70% to mom and 30% to dad. We need to know, because if we don't put the right numbers in, or you don't put the right numbers in when you file your return, that's going to cause it to go into this holding pattern where someone's got to look at it. And we still have clients in that holding pattern from last year right now, even though they filed electronically, and we think it's probably because one of those numbers was incorrect. So that's another thing you have to watch in return filing. But every year, the things you have to watch are making sure you're not kind of standing out like a sore thumb. And so one of the biggest write-offs for realtors is mileage. It's also the number one audited area on the Schedule C by the IRS, because it's the number one abused area. So what we try to tell folks is, if you haven't been tracking your mileage through a mileage app, start. MileIQ, QuickBooks has a mileage app. There's lots of choices, but find one you like and that you'll use, and use it. Because you need something that's going to prove when your trip was business related versus personal. And by the way, that's another thing a realtor needs to understand that's new. You got to track everything. So when you report in Schedule C, you got to tell them, I drove 20,000 miles last year, right? And how many of them were for business? How many of them were commuting? You have to tell them everything. It's very transparent, which is also risky for you. So that's another thing, being able to track that and keep your mileage logs. So.
Michael, we know every year we all have to do our taxes, right? Realtors have to do their taxes. But if you have long-term goals, there's other things that a realtor needs to consider. So when you first meet with a realtor, what is the first thing that you need to know to help them?
Yeah, so I've worked with realtors for a while. And so part of any good business owner's job is to understand their audience, right? To understand who their customer is. And so we have kind of tried to identify the psychology of the realtor over time, and we've developed what I call the realtor life cycle. And so what that is for us is that we basically about have 4 stages of realtors. We have new realtors, that are new to the market, which we kind of talked about, trying to help them a little bit here. We have what we call realtors that are growing. And so they're closing more deals per year and getting some traction in real estate, building their book of business and referrals. Then we have what we call successful realtors, and those are the realtors that have tipped the point where their real estate business drives their family's income, right? Like they live off of this business now. It becomes very real for them, right? Because they have to, this is what's going to drive and pay the bills and fund the retirement and all that. And then we have what we call legacy realtors who have really been doing this a while. They start to get into the platinum groups. They're very visible. They might even be passing this down generationally or have come from another generation of realtors. And so the first thing we do is say, well, where are you on this continuum? Because it's going to tell me a lot about what you've been exposed to and what you haven't, right? And so we tend to meet a lot of realtors in the growing stage and the success stage where they're starting to have some financial pain in and around their taxes. There's two truths that I try to preach to realtors, right? There's a lot of things we can do that you need to do, that we need to do to help you stay compliant, so that you can focus on the things that are important, selling, growing, nurturing, that kind of thing that are relational. But one is you can't lose your expenses, right? Like, so you got to keep track of them, because what's going to happen for the new realtors, they're going to try to do their tax return. And let's just say you're listening to this podcast and you go, well, Michael said I need a P&L. Let's do that. Let's get it done. And you're going to go, well, shoot, I got to pull this together from somewhere, right? I'll start with my bank statements. Oh, I'm not sure that count everything. Let me go to my credit card. Whoops, Venmo, Zelle. What did I use, right? Apple Pay. And you got to pull all this together. So the first thing we teach is don't lose your expenses. And the way we encourage you is to connect, to have one bank account you use and one credit card, right? And that way, let's just say you don't keep track all year long. You now have only 2 places to look. And in most cases, you can download a whole year's worth of transactions from your bank. And if your credit card company's nice, they give you a little pie chart that has color-coded, hey, it's not accurate, but it's at least something. And, you're not in the dark looking for that. So that's kind of rule 1, don't lose expenses. And 2 is don't get behind on your taxes. And a very simple way to keep from getting behind on your taxes is to save money from every close. So what we practice or what we preach, and we try to enforce the practice of, is saving 20% of every net commission. So when that commission comes in, and there's lots of different techniques. It could be a savings account. There's lots of different savings account mentality. Pay yourself, pay your vacation, pay your future. We say take 20% and set it aside. And that's to cover your taxes and to cover your retirement if possible, right? But that's going to be very difficult for a young realtor, right? Because when you have cash flow that's inconsistent and you're not closing enough deals to actually cover your living expenses, you're supplementing your income some other way, then you can't set aside 20%. You may need the first 2 closings to pay off the credit cards or to catch up on this or that, and that's okay. So then as soon as you can, try to take 5% of the next close and set it aside. And maybe 2 closings later, you're taking 10. So what we don't want is a problem to regenerate and get bigger and bigger and owe the IRS money. They're the best debt collector in the U.S., so we don't want them, and we do people's payroll, so we're familiar with garnishments and stuff. We don't want to see our clients in those situations. So I think it starts there. So we look at the life cycle. We try to apply the 2 basic principles, so that realtors, those should be palatable, right? And then you can action some other things from there. Then we start talking about this concept of perfecting the tax savings.
So dive into that a little bit.
So perfecting, I'm kind of a nerd when it comes to stuff like this, acronyms, and then thinking ahead about how you can make this palatable for people and build programs around it. So perfect is a way that I was able to organize my thoughts around how do you get your tax bill as low as legally and humanly possible. There's a series of steps you take, right? So perfect is, there's like 7 different activities you go through, if I can count right. I hope I can. I'm an accountant. The first thing you got to do is picture taxes differently, right? So what we teach realtors is to say, look, it's not okay, because a realtor is going to go, let's just pretend I'm that young realtor, and Michael said, find my 1099, check, it looks right, create a P&L, check, it's as good as it's going to get, and I put it in TurboTax, the realtor's probably going to feel pretty proud of themselves, right? And I did a good job, and I think that's fine. And accountants think that way, right? So we think we took what you gave us and we put it in there and it's in the right places. We did a good job. And the accountant says that's an A+ return. But I want the realtor to have a different judging criteria. I want them to say, no, I'm not happy with where everything is. I'm fine with that. I'm unhappy with the outcome, which is I paid way too much in taxes, right? And so I use an expression I call tax efficiency, which is kind of the relation of how much money you keep versus how much you're paying back. And so in theory, so you have 20% that you're paying in taxes to the IRS. We're trying to get that number down and the efficiency up. We want that 80% to become 81, to become 82, so you're taking home more of your money. So the first thing is picture it differently, P, right? And then get disgusted, and then do something about it. So the second thing that's the easy win is to elect the correct structure. So a very common structure for a realtor or a service-based business is an LLC taxed as a subchapter S or an S corporation. That's crazy talk, and we're not going to get into all what that means now, but what it does is save you tons of money. It comes with a bunch of responsibilities and new compliance requirements and new costs, to be frank. It's not cheap, but it saves you money. The whole thing saves you money. So we try to get them into a structure that saves them money, right? And then we start working down this perfect. Redefine your income is R. It's how do you pay yourself, right? You want to pay yourself in a way that has the least amount of tax consequences associated with it. When you're a Schedule C filer, you're quote unquote paying yourself what's left over. It's taxed. It's not double taxation. It's not a fair thing to say, but it's super taxation. Let's call it that. Because you're paying Social Security and Medicare times two. Realtors don't know this, but if you make a $100,000 profit, let's all pray for that, right? I'll make a $100,000 profit in my business after all these write-offs, and let's say I'm in the 25% bracket, which doesn't exist, but it's round. You actually pay another 15.3% in taxes, just about, on Social Security and Medicare. So that $100,000 at a 25% tax rate, at 15% more, is taxed at 40%. And this is not a real number, but you'd be paying, in concept, $40,000 back in taxes, which is outrageous. That's the wrong type of way to make your money, okay? So we try to make sure we redefine how you're making it. That's what the S Corp helps us do, but there's other ways too. So that's another thing. The next thing we want to do is fund your retirement. Okay, we got to start paying our future selves, right? And it comes from today's money. And if you've heard anything about money and how money works, the earlier you pay in, the better. So if you're a legacy-minded person, you got to start thinking about paying it forward for your kids, right? And the sooner you do that, the better off they are, so they don't have the same struggles we did, right? Next, we want to talk about capturing our expenses. That's the C. No, I missed E. That's engaging your fringe benefits. So, and realtors should be able to appreciate this. Some of the most successful realtors find a way. If you're seeing things that are branded, and they're always, you find a way to intertwine your business life and your personal life such that you legally write off those things that are fringe benefits for you through your business. And there are ways to do that, and there's certain types of things you should be looking to do to reduce your tax bill and kind of pull some of those expenses in as business expenses. That's fringe benefits. Then we talked about C is capturing it, right? So really, I told you that really belongs in the beginning, but you can't spell perfect with a C in the beginning, so it goes here. And then the last thing is the T is taught to your advisor. But this methodology is iterative and progressive. So you could be doing, I talk about retirement. Retirement has more than one level, right? You could be getting to the fund your retirement piece and start with an IRA and kick $6,000 a year into it, $6,500, whatever the limit is for that year. But that's just scratching the surface. You might then say, okay, well, I can get a SEP IRA, because I'm self-employed, and I could tuck a bunch of money into there. And now I'm getting into a new stratosphere of where I can put in. Well, then I might graduate to a solo 401k, or maybe I've hired a transaction coordinator and I want to pay him a wage, and we need a safe harbor 401k so we can both contribute to this thing. And it keeps you can go up and up, and you can do that with almost any, not so much structure, but a lot of these buckets, there's a lot of different things you can keep doing. And going back to the life cycle, what happens is as you're maturing, you're wanting to pull more levers, right? You're wanting to take new tools out of the toolkit to save you some money, Because every dollar you save, you're reinvesting either in yourself or your business or your future. And so, the perfect concept is almost mission. It's like a mission-oriented concept, right? We got to deploy this thing and have the structure in place and train and educate realtors on it so that they are saving as much of their money as possible to reinvest it however they want to. That's the key. And so you asked me, well, how do we talk to a new realtor? We got to first start by saying, where are you? The second step is like, where are you going? Right? Are you looking at real estate as how you're going to build generational wealth? Are you looking at it to invest yourself and flips like you see your clients do, right? Are you looking to do short-term rentals, long-term rentals? What are you looking to do? Are you trying to get a certain number? Let's find out what that looks like. And then what we're supposed to be doing along the way is making sure we're marching towards that objective, right? Making good long-term decisions, even at short-term sacrifices sometimes, to make sure that you're going to get where you want to go. That's perfect. I could go on and on about this stuff. I'm real passionate about it, but I think we see it saving realtors tons of money.
Well, and when you talk about structure, what came to my mind was the current environment, right? So we have a very competitive housing market. We have the pandemic. How has that impacted taxes, or how someone should consider filing their taxes, especially in the last 2 to 3 years that we've seen all these changes?
Yeah, I mean, that's a great question. I would say, as a fundamental rule, I would say this. I don't subscribe to whims. And so I think that outside forces to our business are just that, right? Using simple examples, some forces are a little more critical than others. So if you were in a heavy investment strategy, I mean, I had clients that literally just got their first Airbnb and then the pandemic hit. And so now they're sitting on a mortgage that they weren't anticipating. I mean, they were convinced, right? This is in a prime location. We're coming into rodeo. All this stuff's about to happen. All these, this thing's going to be booked up. And the darn thing was vacant, right? And you couldn't put anyone in it. Travel restrictions and then, all the stuff that came with it. Self-quarantine, all these things. It wasn't months later until they were able to turn that into a midterm or longer term thing. They had traveling nurses staying there. And so they had to rethink how you did it. So I don't think that the situations necessarily inform the decision, but there are some exceptions. Like if you started a restaurant business 2 months before the pandemic, you likely didn't survive, right? Real estate was not one of those things. I was worried early on, and I remember early in the pandemic, I mean, we do quarterly payroll a lot for realtors, and here it is, the end of the first quarter, and we're like, oh God. Usually with a realtor, we get into rhythms and they pay themselves the same amount every quarter. Sometimes it'll fluctuate up and down. Sometimes realtors get into a pinch and maybe that first quarter that's usually slow, they have to bring it back a little bit and say, I don't really have the cash, so I'm going to pull back my wage. But most times people pay themselves something. They don't go with a donut, right? And there I was going, man, I wonder how many people are going to be scared right now and be holding onto their cash. And I was surprised that it wasn't as many as I thought it would be. But that's a real thing, right? So we were all sitting there. How the heck do we show houses, right? I think it's really about being adaptive, because what I found through the whole experience, now we're two years through this experience, the beginning of it, last year with multiple offers really was hard, right? Because you're doing a lot of legwork, and it kind of comes back to another philosophy I have, which is at the end of the day, if you stay right with the IRS and you're saving your money as you go along, and you follow my basic principle of track your expenses by only using certain methods, then you don't have to stop and worry about those things. You don't have to worry about a letter coming from the IRS saying you owe them money. You don't have to worry about setting up a payment plan when times get tough, because you've done the basic things so that you can focus all your energy on what you're talking about. How do I handle multiple offers? Should I be changing? Okay, the inventory is tight. Do I need to partner up with someone? Hey, if it's getting tight, do we need to think about that? Should I be working with another realtor and sharing a transaction coordinator? Should we be backing each other up in case one of us gets COVID? Being able to leverage yourself as a business owner to respond to the demands of the exterior pressures by not having to focus on your internal stuff is key. And that's how I run my business. I don't assume, like we're in a market right now, it's very difficult to hire. The prices are through the roof. The expectation is most people are going to be remote. They think they pretty much think they can now, and I think they're right. And so it's changed the dynamic of how you hire. But a lot of my peers will take a sunken attitude about it and say you just can't hire, and I think that's a ridiculous notion. I think you just have to be more creative in how you do it. You might have to consider more outsourcing or breaking stuff into smaller pieces, right? And that's the encouragement I would have for realtors, is that you know, if you look at the legacy realtors on our list, you go, well, how did they handle it? They handled a burst, right? They handled the downturn in '08. How did they make it through? They have rental properties that were vacant. How did they handle it? And you'll find that success leaves clues, and there's a way through no matter kind of what the exterior pressure. I know that's kind of long-winded, and I hope I gave you some kind of decent answer.
No, that's great. No, and it makes a lot of sense. I think, when you and I were talking about this, and how important it is to do things right, but also to do things early. That way, your finances are already set prior to, any of these changes taking place, and kind of being on track. So talk a little bit about that. It is important to do things right and do them early, right?
Yeah, I agree. I mean, I can keep using the pandemic as an example. I think it taught us a lot, right? I remember kind of giving some talks maybe 3 or 4 months into the pandemic, and we had gotten past the point of talking about PPP loans and all that stuff that realtors really cared about, and unemployment, all that stuff. But then we started talking about use of cash, right? And some people were coming to me that maybe had a little more cash than they were expecting, because their portfolio didn't slow down once they figured out they could virtually show and do these things. Well, we had to start talking then about being careful, right? You're talking about being early. It's like, hey, because when you, in that example, say that someone said, hey, I got extra cash, I think I want to pay off all my credit cards. I go, wait a minute. We want to be thoughtful about that. Once you pay the credit cards off, your cash is gone. The credit card companies are never going to give it back, right? And let's just say that it does dry up, or let's say there's another version of this thing, and in 2 months we get locked down again. Do you have the cash set aside to live through that 60-day period if you just paid off all your credit cards? And are you going to be able to put everything back on the credit cards? So sometimes it's about looking ahead a little bit and just being smart. Because that's the funny thing, Janice, is you can actually mature to the point where you have money built up in savings, where you're paying yourself in retirement, where you're doing all these things, and you can kind of scale that back when things go bad, right? Cash stops, well, I'll just stop funding my retirement for a while, or maybe I'll draw down my savings a little. But if you've never gotten those things done, you don't have anything to draw from. And so realtors are edgy people, I think, by nature. They're very creative and sales-oriented. They're very outgoing. And they're not lent as much to security and safety as much as other people are in other industries, but, maybe my industry. And I think sometimes you just got to step out of that bubble, make sure you're talking to someone that pushes you to do those things, because the more security you put in place for yourself, the easier it is to make changes and to weather storms. Because the realtors that won't survive economic downturns or busts, we've been so fortunate here in Central Texas. I can't remember how much the housing market dropped, but it couldn't have been more than like 6% when it was dropping 40% in Vegas and whatever, doing these huge changes. So we've been fortunate here, but we won't always be that fortunate, likely. And if you don't have these basic things taken care of, then those are the realtors that are going to find themselves out of real estate. I had someone hit me up this morning who had a great year last year, and we set him up in an S corp because it's the right thing to do. And he's literally, I don't know what his situation is, but he's come back to me and says, hey, I don't think real estate's going to be my focus this year. Do I shut it down? And to me, that's it's a boomerang effect, right? It's like, whoa, we're kind of jerking our head back and forth, and that's not a practical way to be successful.
It's very important, I think, for our members to understand this, because I think that's one of the biggest concerns is, especially for the newer realtors where they're starting out and they have all these questions about, filing and the right way to do it, and what are the options out there for them, right? And so you're helping us answer all those questions. I did also have a question for you. How do you foresee the backlog in the future when it comes to the IRS? Is this going to be an issue that's going to trickle down into the next 3-5 years? Or is it something that you think will eventually, catch up?
So This is probably, so my answer is it's a real problem that's not getting better. So I could go back to where I started and tell you all the statistics. Here's another one I found the other day that made me really sad, is that the IRS had 5,000 tax processing positions open. And there's a group called the Taxpayer Advocate, who's a separate entity outside. They're not part of the IRS. They're funded by the government to be a watchdog and be an advocate for everybody, people like us, right? And they gave us the House and Oversight Committee. No, it wasn't House Oversight. It was one of the committees at the House. They gave a State of the Union, basically the IRS. And on that note alone, the 5,000, only 127 positions were filled. And the problem is the IRS is paying crappy wages, asking them to do crappy things. There's mandatory overtime now. So if you think about it, I just explained the Great Awakening and the Great Resignation have told us that we can work for anybody anywhere if we have the skills. Why would people want to go work for the IRS if they've got antiquated systems? They know they can't answer the phone for everybody. I mean, it's a real problem, and people in my profession are quitting the profession because of it. If they focus, we don't focus just on tax, right? We focus on all the things that support it. And so if all I did was tax prep, it would be a very depressing environment. So I think it makes it more important to be working with people who understand how to navigate that. And I got to tell you, even my seasoned realtors, they lose their lunch when they get a letter from the IRS that certifies saying they're going to seize their property, and it's unwarranted, and there's literally there's nothing we could do about it besides wait. Because the truth will come out, it'll get straightened out eventually. So I hate to be gloom and doom about it, but it's a real problem that's going to, the fix is that there's going to have to be a ton of money put into it. And between wars overseas and winding down pandemics here and all that stuff, it's just like, is it getting the attention it deserves? I'm not sure. It affects all of us. And so our lobby and our industry groups have made a concerted effort to start getting the word out. They're getting on all the news. They're trying to get us to tweet our representatives, to use Facebook posts to our representatives to let them know, hey, this impacts us. We need y'all to fix this. One of the very simple fixes they did, I haven't shared yet, is we asked for a list of things, right? And one of the things was stop sending the stupid notices. Like, if you know, there were two major things we asked for. It's like, if you know it's taking you 190 days to get to a correspondence from one of us, then you can't keep us tied to a 30-day notice window. You need to make the notice window line up with how long it's taking you to respond. They didn't address that, but what they did is they turned off some of the notices. So for a client who got a letter that said, we're about to seize your property, they're going to not get that letter going forward until, they stopped those. Like as of about a week and a half ago, the IRS said, we're going to stop sending those notices, certain notices, but scaring the bejeebies out of everybody because we can't even address them anyways. And even though the client has probably done all the right things at this point to try to resolve it, it's stuck with them. So those are little things they can do, but the real answer is system upgrades, people upgrades. It's kind of concerning. I tell my clients, stay electronic. God bless, some of them want to write a check and send it to the IRS. First of all, I don't trust the Postal Service to deliver it. Second of all, when I hear stories about checks being in piles, I don't think that's a good thing. So I try to encourage my clients to be as electronic as possible. You got to get comfortable with that. That's another thing. If you get into real estate, you better get used to electronic means, right? Signing documents electronically, all the virtual stuff. Get comfortable with it. If your attitude is I don't trust the internet, then you got to figure something else out. Because I'm just saying, I'd rather the IRS touched my bank account and pulled the money out than the check got lost and then they started sending me letters. So. But it's just not looking good over there, unfortunately.
Yeah, I can't see how that would be fixed anytime soon by the sounds of it. So, but Michael, is there anything else that you would like to add that's important that I may have not asked?
No, but I'll say this. I'll just say as a parting word, don't worry about the gloom and doom. I don't, and I do this for a living. The real estate market's great. I've been doing this a while, and I continue to see people thrive and build wonderful futures for themselves and their families in real estate. And doggone it, I tell you, regardless of what gets thrown at them, the realtors who are determined continue to generate results year after year after year. So it's a great industry to be in. And we're here to support realtors any way we can, on the finance side of things.
Well, Michael, I mean, this wraps up today's podcast, but I want to thank you so much for being with us and providing us such great advice and insight. Thank you.
Thank you, Janice.